So welcome to tonight's session. This is FAQ 4861, FAQ 4863. So in tonight's session, we'll be covering leases. I'm just going to give a quick overview on leases. I'm going to do a thorough overview in the free masterclass. So tonight's overview is just going to be on lessees. Okay, but in the free masterclass, which is Thursday and Friday, on Thursday, I'm going to spend that session going through a high-level overview on leases in its entirety, and then on the Friday we'll do a question. We obviously won't be able to do a question on every aspect of leases, but we will select a question that is going to be useful. So in tonight's session, I'm going to give you a quick overview on leases, but for lessees. Okay, so like I don't know if you read that workbook or the PDF that I sent earlier today. So just a high-level overview about that. And then we will do a question on leases. So remember, we won't be able to cover every possible question. So you must know that you must be able to disclose leases. You must be able to calculate something relating to leases, and you must be able to do the journal entries. Okay, so remember, you must be able to do everything regarding leases. We can't cover everything, but just make sure you can present it in the financial statements, meaning what is the impact on the balance sheet? What is the impact on the income statement? You must be able to disclose it in the notes to the financial statements, and you must also be able to do the journal entries. And as a result, for any of those three, you must be able to calculate the necessary amounts relating to leases. Okay, so just be aware, if you do a question, try to ask yourself, what do the journal entries look like? How does impact the income statement? How does impact the balance sheet? And how would it impact the notes? If for every question you can do that, then at least you don't have to cover every question. So for every lease question you cover, if you cover those aspects, that means you're covering leases in its entirety. So you don't need to do 1,000 questions. So just think about that. Okay. So like we said, I'm going to focus on leases for lessees. Before we get into that, when you get a lease question, it's very important to identify who is the lessee and who is the lessor. That's the first thing you need to identify. The second thing you need to identify is from whose perspective are you doing the lease accounting? Are you doing the lease accounting from the lessor's perspective? Or are you doing the lease accounting from a lessee's perspective? Very important. Okay, so that is why the first thing you need to identify who is the lessee and who is the lessor. Now, once you identified who is the lessee, who's the lessor, you need to identify whose perspective are you looking at. Okay, so from our perspective, or at least for this explanation, we are looking at from the lessee's perspective, the one using the asset. Okay. So when it comes to lessees, there is basically no choice between a finance or an operating lease. All leases are basically treated like a finance lease. So that means the lessee will recognize an asset and will recognize a corresponding liability. So when we're dealing with lessees, we'll always treat basically every lease like a finance lease. So what does that mean? We recognize an asset and we recognize a liability. This asset that we recognize, we refer to it as the right of use asset. This liability we recognize, we refer to it as the lease liability. So very important. There are, however, exceptions to this basic rule. So there are two exceptions. Remember, the company must choose to elect it, but they can only choose to elect not accounting for a lease like a finance lease, but rather they can expense it immediately in two circumstances. So number one, you have a short-term lease, or number two, you have a low-value asset. Now, a short-term lease is any lease that is 12 months or less, okay? So a short-term lease is any lease that is 12 months or less. So if a lease is 12 months or less, it is considered to be a short-term lease. So for a short-term lease, a lessee may choose to not apply the normal lessee accounting, okay? The second example or second instance would be if you have a low value asset. Now, every company will have to determine what is a low value asset to them. So in an exam, they will tell you if the asset is low value or not. If the asset is a low value item, then the lessee may choose to use, may choose not to apply the normal lessee accounting. So very important. Just think about it. If you think about ShopRite, Pick n Pay, and so forth, what are significant leases to them would be the shops that they are renting, right? So those are significant leases, but for them, so most companies, they don't buy printers, okay? They lease printers. So they're going to lease printers. Now, they may consider those leases to be low value, okay? Because, I mean, like for low value item, there's no need to go through all this hectic calculations to comply with the normal lessee accounting, and that is why the accounting standards allow you to use like if I can say, a scaled down version. Basically, a short-term lease and a low value item, low value asset may be you basically apply operating lease accounting. Okay, so just be aware of that. So I'm not going to go into that. You might just know that that is a possibility, but we're going to focus on the normal lease accounting, which is somewhat like a finance lease. Okay, so remember, for every other lease that is not a low value item or short-term lease, we apply normal lessee lease accounting. And that is, we recognize an asset and we recognize a liability. We say debit right of use asset, credit lease liability. So that's important to take note. So now, so remember, with every asset, it basically goes, it goes through stages, goes through 3 stages: initial recognition, subsequent measurement, and then derecognition. So remember, initial recognition is when you enter into the lease for the first time. So therefore, you're going to have to recognize the lease for the very first time. So you will apply. So then you will have initial recognition. At initial recognition, you will have to have initial measurement. Now, at initial measurement, we will say debit right of use asset, credit lease liability. There may be some other credits as well, but we'll deal with that when we go through the question. So in order to determine the lease liability, in order to determine the right of use asset at initial measurement, there are basically 4 things you need to take into account. You need to take in the lease liability at initial measurement. You need to factor in any direct costs. You need to factor in any prepaid expense, and then you need to factor in any provision for that decommissioning liability. So those are the 4 items that will make up the right of use asset. As you can understand, one of those 4 things is the lease liability. So that means you technically have to calculate the lease liability first. Now, to calculate the lease liability at initial measurement, there are 5 things we take into account. What are the 5 components? Any fixed lease payment, any variable lease payment. Now, this one is very, very important to understand. It's not any variable payment, it's a specific variable payment. So it's a variable payment that is linked to an index, like inflation or something of that nature. So when the lease contract has some variable payment that is linked to some index, like inflation, the CPI, then it's only that variable payment that we will consider. Any other variable payment, like linked to sales, is not included in the lease liability. Okay, very important. There are many questions that has a variable payment, but the variable payment relates to sales. And as a result, it is not an index, so we will not include it in the lease liability. So what are the 5 things? A fixed lease payment, a variable lease payment that is linked to an index, any termination cost, assuming that the lessee will terminate. Sorry, quickly. No. This termination is an early termination penalty. So let's say you enter into a 5-year lease, and most leases will have a termination penalty for early termination. So if the lessee expects to terminate the lease before the lease term, then they will have to factor in the termination costs, the termination penalty. However, if the contract does have a termination penalty, but you do not expect to terminate early, then you do not include it. So just be aware of that. Okay, so that's number 3. Number 4, what is number 4 now? Number 4, it is the option to purchase the asset at the end of the lease term. If the contract has an option to purchase the contract at the end of the lease term, and the lessee expects to exercise that option, only then will you include it. If the lessee does not expect to, exercise the lease option, then you do not include it. So just take note of that. Then number 5, I can't now think number 5. I think number 5 is a guaranteed residual value. Okay, so that's the 5 components. You can see the, sorry, quickly. Okay, so basically at initial measurement, we are focused with 2 things: when to recognize and at what amount. So remember, when do you recognize? At the commencement date. When is the commencement date? When the rights to the when you have the right to use the asset. So the moment you have the right to use the asset, that is the commencement date, and that is the date when you have to initially recognize and measure the lease asset and the lease liability. And we explained how do you measure it at initial measurement. Okay, so that's very important to take note. So at the date of, so what I do is, when we do the calculation, I will list all 4 components, I will list all 5, so I will list all 4 components for the right of use asset, and I will list all 5 components for the lease liability. And if there's nothing, I'll just plug in 0. That just trains myself to remember the various components that needs to be included. Okay, but I'll show you how to do that. Now, remember, like we said, with every balance sheet item, asset liability, you have initial recognition, and we discussed that. Then you have subsequent measurement. I'll talk to that now. And you have derecognition. Now, remember, for a lease, the derecognition will simply be for the right of use asset. It's going to be you're depreciating it over the lease term. So as a result, at the end of the lease term, the right of use asset is 0. So it's fully derecognized. Same with the lease liability. There would be interest recognized, and there would be a payment recognized. So by the end of the lease term, the lease liability will be 0. So the way we derecognize the asset and the way we derecognize the liability is through using the asset and through making the regular payments for the liability. Okay, so that is how the asset and the liability gets derecognized. Okay, very important. Just on this point quickly, on a right of use asset from the lessee perspective, remember, from a lessee perspective, from accounting perspective, we're recognizing a right of use asset and we're recognizing a lease liability. So just be aware of that. Remember, there will most likely be deferred tax they will most likely ask you for deferred tax consequences. So you must know the deferred tax consequences. So remember, how do we do deferred tax consequences or the deferred tax calculation? We apply the balance sheet approach, which means we list all the assets and all the liabilities. So we have a column for assets and liabilities, we have a column carrying amount, we have a column tax base. Now, when it comes to lessee accounting, the lessee, from an accounting perspective, would have a right of use asset and would have a lease liability. From a SARS perspective, SARS doesn't see that. So there will be nothing for a right of use asset from SARS's perspective, and there will be nothing from for a lease liability from SARS's perspective. Very important to understand, okay? Because remember, SARS is only going to give the company a deduction for the lease payment. They're not going to grant any depreciation. They're not going to be granting any interest or anything of that nature. So just take note that from SARS's perspective, there's no right of use asset and there's no lease liability. Okay, so there will always be a temporary difference. Now we come into subsequent measurement. Now remember, at initial recognition, we said debit asset, credit liability. So under subsequent measurement, there will be two sets of journal entries. The one set relates to the right of use asset, and the second set relates to the lease liability. Okay. Now I'm discussing this in terms of the lease being coinciding with the financial reporting period. So let's say the financial reporting period is 1 Jan to 31 December. The lease is also 1 Jan to 31 December. This may not always be the case. It may be the case in most cases for CTA 1, but the chance of it being for CTA 2, not so much. Okay, so there will be some differences, and I'll quickly mention it, but it's basically the difference will just relate to accounting learnings that we did in first year. Okay, so this explanation is from a point of view where the financial year end and the lease period is exactly the same. Okay. So the journal entry set number 1 relates to the right of use asset. Remember, this right of use asset will be classified into one type of asset. So either, I'm just going to make up stuff. Okay. So it could be PPE, it could be intangible assets and so forth. Typically PPE, because you're gonna lease a machine or something. So typically it will be PPE. So then you would apply rules regarding PPE and so forth. So remember, with PPE, we're gonna have to depreciate. So we'll depreciate, you'll say debit depreciation, credit, accumulated depreciation. So that is the subsequent measurement relating to the right of use asset. Now, when you have depreciation, you have to, you will need a useful life, okay? So the useful life depends. There's one of two choices. If you, what was it, two choices now? Yeah, so if you are not going to purchase the asset at the end of the lease term, if you are not going to purchase the asset over the lease term, you will choose the shorter period between the lease term and the economic life. If you are using, if you are going to purchase, then you will use the economic life of the asset. So just be aware of that. Okay, so the lease, the useful life of the asset depends whether you're going to, whether you're going to benefit, whether you're taking ownership of the asset at the end of the lease term or not. The second set of journal entry in subsequent measurement relates to the lease liability. Now remember, the lease liability is a lot like a loan. It's not like you taking out buying a car and you're paying the bank. It's a lot like you taking purchasing a property and you have a bond and you're paying the bank a bond. So remember, what's going to happen? The lessee is in effect is getting loan finance from the lessor. So what is happening? the lease payment that is paying to the lessor, the lessee is going to say credit bank, because cash is being paid, cash is decreasing, cash is an asset, so therefore assets are decreasing. Assets decrease on the credit side. So say credit bank with whatever the lease payment is. That payment is relates to two things. It relates to an interest component, and it relates to the lease liability. So remember, we first work out the interest component, and the difference goes against the lease liability. Similar to how if you have vehicle finance, what happens with your vehicle finance when you pay the bank? They first take your payment and throw it towards, allocate it against interest, and whatever's left over gets allocated against the capital amount. Same if you have a bond. The amount that you pay to the bank, what they first do of that monthly payment, they allocate first against interest, and any left over will be allocated against the capital amount. That is why as time passes, the capital amount reduces more. Why? Because less interest is allocated against, less interest is taken from the amount you pay. So just take note of that. So the lease liability is simply credit bank, debit interest expense, maybe debit lease liability. It could end up being a credit lease liability, but you will have a look at that. Now, how do we calculate interest? Remember, we calculate interest in the same way we calculated interest when we did financial instruments. It is present value multiplied by I. I would be the discount rate used in the lease. Remember, the discount rate that you use in a lease is the rate implicit in the lease. Okay, so you must use the discount rate or the interest rate implicit in the lease. If you cannot determine the rate implicit in the lease, then what you will have to do, you will use the lessee's incremental borrowing rate. So whichever rate you use, the way you calculate interest is present value of the lease liability multiplied by present value of the lease liability multiplied by I. Like we said, what is I? It is either the rate implicit in the lease or the incremental borrowing rate. Now remember that present value of the lease is basically the opening balance for each period. Okay, so just take note of that. So that is basically how we deal with the lease. Okay, so when it comes to lessees, there are two things you need to focus on: initial recognition and initial measurement, and then subsequent measurement. In subsequent measurement, don't forget there are two parts. The one part relating to the right of use asset, and the other part relating to the lease liability. Now there can be some complications, like in this question there will be some complications, but make sure you have that basics right. Okay, just so you know, like I said, the explanation I gave was where the lease contract coincides with the financial period. So your financial period is 1 Jan to 31 December, and the lease started 1 Jan, started 1 Jan. So every year will also end 31 December. This might not be the case. It could be anywhere in between. So because at year end, you need to account for any income earned or any expense incurred. If the lease payment doesn't coincide with the financial year end, then you may have an accrued expense or an accrued income. So just take note of that. Okay, so that is something you must be aware of. I'm not going to go into those details. That is accounts 1. Okay, so they're just bringing accounts 1 into something that is accounts 4 level. Okay, so just be aware of that. The only other thing I'll touch on now, because it's going to cover through in this question, is the aspect of a remeasurement. So I'll deal with the remeasurement when we come through with the scenario. So just be aware of that. Okay, so that's all I wanted to cover with regards to lease liabilities. I mean, to lessees that's all I wanted to cover about leases for relating to lessees. Okay, we will cover finance, we'll cover lessors, and we'll cover sale and leasebacks in the masterclass. I'll give a high-level overview on lessors, a high-level overview on sale and leasebacks, and I'm going to repeat this high-level overview on lessees. Okay, just so you know, sale and leasebacks does tend to come in for some odd reason. UNISA likes sale and leasebacks, so make sure you can deal with a sale and leaseback. Okay, but we will cover that, at least from a theory point of view. So before we move on into the question, do you have any questions to ask me at this point in time? Anyone? Any questions? Nothing? Yes, no? I am assuming not. So what we're going to do, I'm going to switch over, share my screen. I want you just to spend 5 minutes, okay? Before I read the scenario, I want you to spend 5 minutes reading the scenario. This is, so it's in the Google Drive where we have fact 4863 start letter 106. It is question 1 on page 62. So we're gonna, it's about 2 pages, just more than 2 pages. So if you can spend 5 minutes to read this, and then I will read it with you afterwards. And once again, I'll break down certain important information. So you can see it's two and a bit. And then we're gonna then I will cover, then we will deal with one aspect of the required. Okay. So please, can you, I'll stop you in about 5 to 7 minutes time. Okay. Okay, you guys ready? So I'm going to start reading. So they say amounts include value-added tax unless indicated otherwise. But you might just be aware, they do test VAT when it comes to leases. So that's obviously one level of integration. That's one level of integration, but also in the real world, VAT is always included in, there's always VAT implications when it comes to leases. So they want you to know it. So just be aware, you must know your VAT rules. So tucked away in a valley unknown to many lies a beautiful holiday destination known as Far Away. The off-the-grid holiday resort is renowned for its untamed nature, which is enclosed within majestic mountains and bordering the tranquil coastline of KwaZulu-Natal. This almost sounds like a like you're going on like, you know, those travel brochures. I guess this person who this lecturer who set this paper probably stole those lines from there, which is quite exquisite for an accountant. Far away, mostly a conservation area itself, is surrounded by national conservation areas, which is regulated by the National Parks Board. Therefore, as guiding principle of the resort, vacationers are required to return nature untouched after each valued holiday experience. Okay, so that is some background. I don't think it's going to impact us in any way. Away Ltd, who developed the resort, has a 28 February financial year end and is listed on the Johannesburg Stock Exchange. Okay, so 28 February. So that means at the beginning of the financial year would be 1 March. So here we have Store Away. Away supplies storage facilities to regular camping vacationers since 1 September 2017. Fridges, bedding, and even caravans are stored in these facilities, allow vacationers to travel with more ease on the rugged dirt road, which has been the only access to the resort since it has been developed. The storage facilities consist of 10 6-meter shipping containers. All containers are leased for 12 months, whereafter the lessee has the option to extend the lease for another 12 months. Away offers the first 3 months of all contracts free of charge. The monthly lease payment amounts to R184 per container and is payable in arrears. Okay, so what you must understand, that 3-month free, that is known as an incentive. You must always factor an incentive into the lease to the lease calculation. So on 1 September 2017, all 10 containers were leased to vacationers who indicated that they want to lease the containers for 12 months only. Okay. However, on 31 August 2018, so remember 31 August 2018, that is on 31 August 2018, that is obviously the end of the lease contract for 12 months. All 10 lease contracts were renewed for another 10 months with a 10% increase in the monthly fee payable. The benefits obtained from the lease transaction is consistent throughout the duration of the lease period. You may assume that all of the lessees paid the accounts on the respective due dates. Okay, so remember they're using a 12-month lease. So remember, any lease that is 12 months or less can be considered to be basically depending on who you're looking at. So you must first identify, are you looking at from the vacationer's point of view? The vacationers would be the lessee, or you're looking at from Storeway's point of view. Storeway will be the lessor. When you deal with lessors, you have to first classify a lease. A lessor has to first classify a lease, either as a finance lease or as an operating lease. Okay, so just take note. So they say Away depreciates 6-meter shipping containers, which are utilized for their own storage purposes on the straight line method over 10 years. Away is a registered VAT vendor and is liable to pay VAT when the customer has been invoiced. Okay, so just take note of that. That is obviously from Stowaways' point of view, they are lessor. So this indicates that it's just basically a normal operating lease. So when you do an operating lease, we apply straight lining. Okay, so remember, in this scenario, they will be paying only for 9 months, depending for the first year from 1 September to 31 August, from 1 September 2017 to 31 August 2018, they're only paying for 9 months because the first 3 months is free. And remember, but what you're going to have to do, you're going to have to smooth that lease over a 12-month period. Okay, but that you can deal with. We're not going to cover anything relating to operating leases. So this is the main section that we're going to deal with, because in this under this section is where we're going to deal with the right of use asset. So fly away. Mr. Hathaway is a regular vacationer at Far Away and founder. Oh, wait. Mr. Hathaway is a regular vacationer at Far Away and founder, as well as chief executive officer of Herway. Herway recently listed on the Johannesburg Stock Exchange and has a 28th February financial year end. Mr. Hathaway's wife is not a shareholder or part therefore. Oh, this doesn't make sense. Mr. Hathaway's wife is not a shareholder or part therefore thereof. I don't know. The management of Herway. I don't know how that reads. However, to his dismay, she is too well accustomed with having her way. Wow, okay. This is, obviously this guy is, whoever set this paper is trying to have fun. Okay. She convinced her husband to persuade a way to build an airfield next to the resort, as she found the travel by road too exhausting. On 1 July 2017, Mr. Hathaway transferred 57,500 from a Herway bank account to Away in order to assist Away with the building of the airfield. Even though it is not truly in line with the guiding principle of the resort, the directors of Away evaluated the economic value it will add to the resort and continued with the development of the airfield without necessarily considering any possible regulations of the National Parks Board or the effect it may have on other stakeholders of Away. Away completed the building of the airfield on 25 September 2017 at a cost of 600,000 Rand, excluding VAT. Away and Herway signed a contract for a 10-year lease of the airfield, which will commence on 1 October 2017. The contract contained a clause that Away has the option to terminate the lease earlier without any cost payable to Herway. The contract also indicates that Herway has the responsibility and any associated risk to restore the area at the end of the lease, at the end of the useful life of the airfield, or earlier should the contract be terminated prior to the end of the lease term. Okay, so just take note of that. In addition to the 57,500 Rand, Herway has to pay a monthly payment amounting to 9,775. The 55,000 payment received from Herway will be a payment in advance for the lease of the airfield. Herway estimated on 1 October 2017 that it will cost the company 250,000 Rand, excluding VAT, to restore the area in 10 years' time and correctly accounted for the decommissioning liability at 101,984. Since Herway was unable to calculate the rate implicit in the lease, the company utilized its incremental borrowing rate of 9%, compounded monthly, to calculate its lease liability relating to the lease contract. Okay, so let's just stop over there. So what you can see what happened over here, Herway asked Away to build a what was it? An airfield. Okay. So what you're going to build the airfield for 600,000 Rand. Herway provided a 57,000 Rand as a deposit. And then because the thing will last for 10 years, the airfield has there's a contract signed for 10 years. And I'm assuming the airfield will only be for an economic life of 10 years. What is happening? Herway has to pay a monthly lease payment to Away. Okay, so just take note of that. So basically, the asset is Away's asset, but Herway has the right to use that asset. Okay, so just take note of that. So Herway is going to pay Away that 9,700 Rand every month for the next 10 years. Okay, so where are we? Okay, so say nature-loving vacationers, both at far away as well as neighboring conservation areas, were unsettled with the airfield, mainly due to the accompanying noise they had to endure. On 27 February 2019, the National Parks Board informed Away that the land on which the airfield was built formed part of a protected area, and by law, Away was not authorized to develop this specific piece of land. Away immediately appointed experts in the field to oppose the matter in the upcoming court case on 1 March 2019. However, on 1 March 2019, the court indicated that Away indeed had to restore the area to its original condition, but permitted Away the further use of the airfield for another 2 years to allow Away sufficient time to rebuild the airfield on another legitimate piece of land. Away informed Herway of the outcome of the court case on 2nd March 2019. Away had no intention to rebuild the airfield due to the negative response the company received from vacationers. On that date, Herway determined that its lease liability with regard to the lease contract of the airfield will decrease with 345,000 Rand due to the decreased lease term of 2 years, and estimated that it will cost the company 200,000 Rand to restore the area in 2 years' time. Okay, so just take note of that. So what's happening over here? So just to give you some perspective, remember for Fact 1, Fact 3, there are 4 topics you are going to be covering. So you are covering employee benefits, you are covering leases, leases is significant, and then you are covering provisions and events after the reporting date. Okay, so this year would be court cases and stuff is provisions, contingent liabilities, contingent assets. Okay, so you're falling into IAS 37 provisions. Okay, so just take note of that. So they're going to be testing this year, just basically also bringing into account the provisions that is part of test 4 syllabus. So what's happening? The company built Away built the airfield at the cost of 600,000 Rand. They are leasing this airfield for 10 years to Herway at a monthly amount of 907,000 Rand for the next 10 years. However, at some date, on 1 March 2019, what happened? They were taken to court, and the court said that they have to restore the that airfield to its original condition, and they can build an airfield somewhere else. However, they decided not to build the airfield somewhere else, and as a result, the lease term has now been reduced to 2 years because they have 2 years left. Now, when there is a change in the lease contract and the change relates to the lease term, then it's not a lease modification, but rather a lease remeasurement. So remember, if there's a change in the lease, the change is accounted for in one of 2 ways, either as a lease modification or as a remeasurement. Now, when it is when it's got to do with the change in the lease term, then it's most likely it's generally a remeasurement. Okay, so we will deal with that. They're giving us what is happening to the lease. The lease is decreased. The lease liability is decreasing by 345. I'll show you how we will deal with that. Okay, so that's very important. What you should also know now is that we're going to have to, there's going to be adjustment to the decommissioning liability, because remember at initial recognition, the lease liability in 10 years time was going to be 250, and the present value of that 250 is 101,984. Okay, so this 250 was going to be spent in 10 years time. So the present value on initial recognition on 1 October 2017 was 101,984. Okay, so just take note of that. Now, in 2 years' time, we're going to be covering 200,000 Rand. So we need to work out the present value of that 200,000 Rand today. And any difference, we need to adjust the lease, the decommissioning liability. Okay, so just take note of that. Okay, so additional information. They say that the directors of Away authorized the company's financial statements on 30th April 2019. Okay, so this is important. Remember, we said there are certain topics that you are covering for test 4: employee benefits, leases, provisions, and then events after the reporting date. Remember, when is our reporting date? 28 February. So events after the reporting date is the period from year end up until the date that the financial statements are approved or authorized. So as you can see, the directors authorized the company's financial statements on 30th April 2019. So the period 28 February 2019 or the period 1 March 2019 to 30th April 2019, that 2-month period, that is considered a period where events after the reporting date can take place. Now, in that period, 2 types of events can take place: either an adjusting event or a non-adjusting event. So if you have an adjusting event that takes place between 1 March and 30th April, then you're going to have to go back and change your financial statements. So just take note, that is why they're giving you this over here, because anything that happens from year end up until 30th April 2019, up until the date the directors authorize or approve the financial statements, that period has a period where you can make adjustments to your financial statements. So if it is an adjusting event, you will make adjustments to your financial statements. If it is a non-adjusting event, you will not adjust your financial statements. You may just have to add some additional disclosure. Okay, so this is in the topic of events after the reporting date. The standard is IAS 10. It's a very, very short standard. If you can read it, try to read it. Away has been profitable in the past, and the company expects to be profitable in the near future. So generally, this is to give information if you have deferred tax. So remember, if you have a deferred tax asset, you can only recognize a deferred tax asset if the deferred tax asset meets the recognition criteria. The deferred tax can only meet the recognition criteria if you can benefit from the deferred tax asset in future. The only way you can benefit from the deferred tax asset in future, if in future you're going to make sufficient taxable income to utilize the deferred tax asset. And that is why they're just telling you this, so that if you do have a deferred tax asset, you can recognize a deferred tax asset. Herway measures the right of use asset according to the cost model and depreciates these assets on the straight line method. Herway also presents its rights of use assets separately in the statement of financial position. So remember, when you have a right of use asset, there's subsequent measurement and you have to apply depreciation. But before you apply depreciation, you need to first understand how do they measure the right of use asset. Do they use the cost model or do they use some other measurement model? In most cases, when we're dealing with a cost model, so then you can depreciate like you do like normally with PPE. Then they're telling you here, Herway presents the right of use assets separately in the statement of financial position. Why are they telling you that? because the standard allows you a choice how you present your right of use asset. Your right of use asset can either be presented separately or as part of a class of assets. So for example, this is an airfield that is used by Herway. So therefore it will meet the definition of PPE. So you can either classify this asset as PPE. You will, in the PPE note, you'll have a column called right of use asset, or you can have a separate, you don't let it form part of PPE. You will have a separate thing disclosed as right of use asset. Okay, so you have a choice. In most cases, they will separate it. Okay. So what's going to happen? So what does this mean? On your balance sheet, you're going to have a line item called right of use asset, and it won't be on the balance sheet included in PPE. Okay, so just take note of that. Okay, then they say you may assume that the normal income tax rate is 28% and VAT is charged at 15%. You may assume that an appropriate pre-tax discount rate is 9% compounded monthly. We want it to be compounded monthly because that they said above that the lease liability is compounded monthly, or the decommissioning thing. And remember, we always, from an accounting perspective, we always want a pre-tax discount rate. We don't want a post-tax discount rate. If they give us a post-tax discount rate or an after-tax discount rate, we will need to make an adjustment. Both Away and Herway are registered VAT vendors. So remember, in the first section, when we're doing with Store Away was the lessee, was the lessor, and the vacationer was the lessee. And in that scenario, it was obviously if you're looking from the lessor perspective, you will have to consider whether it is a finance lease or an operating lease. Similarly, over here, with the second part where Away and Herway, Away is the lessor and Herway is the lessee. So if we're dealing with it from Herway's point of view, then we will apply lessee accounting, which is debit right of use asset, credit lease liability. If we are dealing it with from Away's point of view, then we have to first classify the lease either as a finance lease or as an operating lease. This will most likely be a finance lease because the lease, the asset that Away is leasing to Herway is of a specialized nature. It is specifically for Herway. So there's about 5 criteria that makes a lease a finance lease for a lessor. It doesn't have to meet all 5 criteria. It just needs to meet one of the criteria. One of the criteria is that if the asset is of such a specialized nature that basically only the lessee can make use of it, then it's a finance lease. Or if the lessee is going to be using majority of the economic life of the asset, then it's also a finance lease. As you understood in this scenario, that the airway is only going to be for 10 years, and the full 10 years of the airway is leased to Herway. So that means Herway, the lessee, has majority of the economic life, not the useful life, not the lease term, economic life. The economic life is going to come to an end at 10 years because they're gonna break it up. So therefore, once again, Herway has majority of the economic life, actually all of the economic life, and as a result, that also would make it a finance lease. So from Herway's point of view, it would be a finance lease. Okay. So here we're going to come to the required. I want to do part C. Okay. You can have a look at part A. We will deal with part B when we come there. I want to deal with part A. So here you can see this is probably a past paper. 15 marks, operating lease, 12 marks, a right of use asset lease. Okay, so here they say disclose the right of use asset with regard to the lease contract for the lease of the airfield from away in the financial records of Herway Ltd for the year ended 28 February 2019. So we only want it for 28 February 2019. What do we want? We must disclose the right of use asset. Okay, so we have to disclose the right of use asset in the records of Herway. So it's very important, like I said, the first thing you want to identify, who are the parties and who is the lessee and who is the lessor. So we're doing it in the books of Herway. So it's from Herway's perspective. Herway is the lessee, and that is why we're going to disclose the right of use asset. And then one for the period 28 February 2019. They're telling you that comparatives are required and narrative information is not required. Okay, so we're going to be covering this question. Okay. So let me just see quickly. So this is 15, and that is, so 15 and 5, that is 20. Okay, that is 12, 1 and 2, it's 14. Okay, so this is somewhat a past paper because it's 40 marks. So as you can see, out of the 40 marks, 12, 13 marks. 13 marks is for right of use asset. 15 marks is for rental income, which is operating lease. They're telling operating lease. So 15 plus 13 is 28 marks out of 40 is leases. Okay. The only challenging part with leases is that there's different things in leases. So for example, the first thing is you have lessees, you have lessors, and you have sale and lease back. Under a lessee, it's most likely going to be a right of use asset, lease liability, but how they test it, it could be a journal entries, it could be a disclosure, it could be just a calculation, it could be a discussion, it could be where you must prepare the note to the profit or loss. Okay, so like in the other question we dealt with last week, with the lease, you must calculate, but you're going to need the numbers to prepare the profit, the note before profit. You need to prepare the profit before tax note. So you need the numbers. Okay, so remember. So now you have lessees, which is the right of use. But under this right of use lease liability scenario, it is either journal entries or disclosure or a discussion or a calculation, and then the calculation is going to be used in the calculation will be used in the, let's say, in a profit before tax note. Okay, then under lessors, you either have an operating lease or you have a finance lease. For both of those, it's either journal entries or calculation or disclosure or calculation, right? So with the calculation, once again, it's you need to probably just prepare a profit before tax note or something of that nature. Then you have sale and leaseback. Sale and leaseback is quite short. Oh, and sorry, then under lessors, you also have the possibility of the manufacturer dealer scenario. Okay, so you must be able to deal with that. Then under sale and leaseback is quite short in the standard, but there are two options. Either the sale and leaseback is considered to be a sale or it's not a sale. If it's a sale, there's a certain way of dealing with it. If it's not a sale, there's a certain way of dealing with it. If it is a sale, there's a certain way of dealing with it. Once again, either discussion or calculation or journal entries. What did I say? Discussion, calculation, journal entries, or disclosure. Okay, so it's discussion, calculation, journal entries, or disclosure. Okay, so something like that. So we say lessees, what you call it. And then there's then we have some more stuff that they can ask you. For a finance lease, for a lessor, they can have a big discussion whether it is a finance lease or not. Okay, so if they just want calculation, it's going to be very quick to pick it up. But if they want to be a bit more detailed, then they can ask you whether it is a finance lease or not, and you will have to use the criteria and apply it to the scenario. So that's another type of question they can ask you. And then the other question that they love asking, if it is a discussion question, is whether the contract is a lease or not. Because in the real world, people structure stuff like a lease, but they don't call it a lease, or they call it a lease, but it's not a lease. So you will have to, in many cases, you're going to have to analyze a contract, and that's a discussion question, whether this contract contains a lease or not. So those are the typical, so that's what makes leases challenging. It's not that it's difficult, but there are all these moving parts and you don't know which one can come in. And what I can tell you is like an equal, more or less an equal chance of any of those coming in. It's not like there's one pooled here or there, okay? But what most likely will come in from a lease is going to be a right of use and something else, okay? So just take a note. Then you have employee benefits, not too huge. The typical employee benefits is like the one we did, last week, maybe a little bit more complex, but that's going to be the typical. And then you can have this provision scenario. Okay, so just take note. So spend quite a bit of time on leases. Make sure you know the various moving parts. Like I said, I'll give a high-level overview on Thursday when we do the masterclass on all of leases. But then I won't be able to cover every possible question, but I will cover some different question or another right of use and hopefully a lessor type question. Okay, so just be aware of that. So I'm going to focus here, disclose right of use asset in the notes to the financial statements. Okay, so before, I'm just going to switch over my screen. While I switch over my screen and open up the spreadsheet, do you have any questions on your side that you'd like to ask me at this point in time? So, so let's just see before we go on to the calculation. Beniz, Faid, Fakir.
No questions.
Lerato, Rebecca, Rodney, Ryan, Valise. Anything your guys' side?
No questions.
Okay.
No questions.
No questions.
Okay. Okay, so now remember, they want to disclose in the notes to the financial statements. They want us to disclose in the notes to the financial statements. When you make a disclosure, you need to, how the notes would look. So remember this in her way. So when it comes to the financial statements, that is where the one mark of communication is. Prepare the notes to the financial statements. So that remember, there's three things when it comes to financial statements: company name, statement name, and date. So the company name is Her Way Ltd. I think it's Ltd, whatever it was. Her Way Ltd. The company name is Notes to the Annual Financial Statements. So remember, all notes is for the period ended, because we're dealing with a year, so it's for the year ended. The only statement that is not for the period or for the year is the balance sheet, which is as at. Very important to look at those type of stuff, eh? So just be aware of that. So it's for the year ended, and then you put the date. I just put my date over here, 28 February 2019. Okay, so that's where I put my date. You just put it next to, I'm just putting it below to show the three components. Okay, so very important. So company name, statement name, and then the date. Now we're going to have the actual note. Okay, so the note is going to be right of use asset. Okay, so that's the note. So what do they want it for? They want it for 2019, and they said provide comparatives. So the comparatives has to be 2018. So remember the beginning of the year, 1 March, end of the year, 28 February. So the beginning of the year would be 1 March for this period, 1 March 2018 to 28 February 2019. For that period, it would be 1 March 2017, 28 February 2018. Okay, so just take note of that. So the note is basically just a reconciliation. Remember, a reconciliation in accounting is a numerical explanation of how a number, of how a balance went from its opening balance to its closing balance. So remember, on the balance sheet, they would have right of use asset 2018, 2019. So in the note, we will explain how the opening balance went from the opening balance to the closing balance. The way we do that is through a reconciliation. So we will just have basically opening balance, whatever you want to call it, opening balance, and then we're going to have closing balance. So we need to provide an explanation to the users of financial statements to explain to them how did this balance move, because we want to provide users of financial statements with information that is useful, that is relevant, that is faithful, right? So that they can make decisions that are useful. Okay, so that is important to take note. So what are we going to do? What are the things that would cause the balance to move? So what would cause the balance to move? I'll just list a few things. All may not be applicable. What would cause the balance to move is when you acquire a lease in the current year. So when you acquire a lease in the current year, we call it an addition. Okay. So with the lease, you can have so there's basically, what did I say now? Yeah, so you acquire a lease in the current year. So remember, how else can the lease liability, how else can the right of use asset change? So by obtaining the right of use asset for the first time. The second way is, how can it change? Through depreciation. Because remember, subsequent measurement, it would be depreciation. How else can the right of use asset change? So remember, what can also change the right of use asset is anything, because remember what in the right of use asset, the right of use asset includes the lease liability. So sometimes when there's a change to the lease liability, the accounting standard says that change also impacts the right of use asset. So in one instance, where the lease liability will change, and that change also impacts the right of use asset, that is a remeasurement. So remember, a remeasurement applies to a lease liability, but the standard says that a remeasurement impacts a lease liability. So in this scenario, the lease liability decreased. So if a liability decreases on the debit side. So we say debit lease liability with a remeasurement amount of 345,000, whatever it was in the scenario. For every debit, there must be a credit. So where does the credit go? The standard says that for a remeasurement, the other side of the transaction goes to the right of use asset. So therefore, that 345 will also impact the right of use asset. So remember, we said it reduced the lease liability. So we say debit lease liability, 345. For every debit, there's a credit. The credit goes against the right of use asset. Now remember, a credit against an asset is a reduction in the asset. So just take note of that. So here we'll also put in the remeasurement. I think it's called a remeasurement, yeah. Whatever the word is, okay? I think it's remeasurement. And then what you must, it's not remeasurements. I'll just check the standard now. What's the word? Remeasurement, whatever it is, reassessment, something like that. We can see the right terminology. It's something, reassessment, remeasurement, whatever it is. Okay, so, and in the last one, remember in this scenario, we have a decommissioning liability. So remember, the decommissioning liability falls into the standard of provisions. So remember the standard we're going to deal with later on, provisions, IS 37. That standard deals with provisions. what is very important for you to understand, if you want to read the provision standard. If you don't read the provision standard, at least have an idea of what's included in the provision standard. Why? In the standard of provisions, IAS 37, there are different types of liabilities, different types of provisions over there. So for example, there is provisions. Then there is the issue of decommissioning liability, this thing, or whatever term I called it. There's the issue of restructuring. There's the issue of something known as I will get to the terminology now. It's on my tongue. I just can't say it. But anyway, well, I'll come to me now. So in that standard, there are different issues regarding provisions and liabilities. And like I don't know if I told you the story in ITC when I was writing accounting. When I read the scenario, and I was like, okay, cool, I know what's happening over here. I read, I know what's happening. And when I saw the required said, please discuss each transaction in terms of the accounting standard. So now I'm looking at the scenario. There's like, I think 3 or 4 different scenarios, like short mini scenarios, right? It's a typical question that comes up. I'm like, this is all liabilities. So why are they asking me to discuss every scenario? This is all liabilities. And that was just confusing to me. Then I was, so like I said, I was sitting there, but I wasn't messed up at this point in time. I was quite okay with accounting. So when I read it, I'm like, okay, I'm not 100% certain because it's all liabilities. Why do they want a separate discussion for each thing if they're all just liabilities? Then I remember the way of thinking. So my accounts 3 lecture, although I was in accounts 4, but in accounts 3, one of the lecturers always used to tell us the following. And so I also tell you, because it plays a significant role, is that in accounting, there's basically 3 things you look at, right? In most cases, we do it automatically, but when you want to apply it consciously is when you struggle with something. So the first thing is to think in terms of the accounting equation. The accounting equation tells you whether something is an asset, a liability, or equity, income or expense, right? So the first thing you do, you go through the accounting equation. The second thing you do is that you make sure that the journal entry balance. So once you identify the elements, you balance the accounting equation, which is your journal entries. If you get that, then you should be on the right path. So that is actually 1 and 2, but it's actually that is 2 and 3. The first thing you must do, and this is most likely going to happen in first year, second, and third year, not so much. In GDA, in CTA 2, definitely, a complex transaction is required to do number 1. And that is to first understand the transaction. So that means you ignore accounting completely and you understand what is actually taking place from a transaction point of view, or how they call it from an economics point of view. Once you understand the transaction, you then apply accounting treatment. So for example, you go to the shop and you're going to Pick and Pay. You bought groceries, you come to the till, you give them money and they're giving you the groceries. So what happened, if you ignore accounting, what happened is that you bought groceries in exchange and you gave them money. Now that is understanding the transaction. That is understanding the economics of the transaction. And now you apply accounting treatment. You look at the journal entries. You think of the accounting equation, assets, equity, liability, income, expenses, and the second thing you do, you balance the equation. Okay, so that is generally what you do. But throughout the year, you'd always tell us that when you do the accounting equation, that only tells you whether it's an asset, liability, equity, income, or expense. But the next step you need to understand was the accounting equation is in the conceptual framework. The conceptual framework tells you whether you have an asset, a liability, equity, And under equity, whether it is an owner transaction, income and expense, or whether it's a business transaction, capital, share capital, or dividends, right? So that is what the conceptual framework deals with, the accounting equation. But the next step is then once you have an asset or once you have a liability, is to identify, is to classify the asset in terms of an accounting standard, to classify a liability in terms of the accounting standard. So because he used to do that with us often in third year, he often remind us that. I used to apply that in accounting when I was in GDA. So when I struggled, my thinking was accounting equation, journal entries. After the accounting equation, apply the standard. So when I did that in ITC exam, I was like, okay, this is a liability for sure. Which standard is it? So now I'm going through all the standards we went through over third year and in GDA. Then I came only with two standards: provisions and IFRS 9 financial instruments, but financial liabilities within financial instruments. Crystal clear, it is not financial instruments. So it's only I-37. I'm scratching my head. How do they want? It's just I-37. It's one standard that I must deal with, and they want me to discuss each one in terms of the accounting standard. But then I realized, so what I just went to I-37, I just popped in my head that I-37 deals with different issues. So then you go to the standard and it deals with provisions. It deals with contingent liabilities. So contingent liabilities, we'll cover that. And then it deals with, like we said, restructuring. It deals with, this one we can deal with over here, the decommissioning liability. And the other one that it deals with that I couldn't remember, but now it came to my mind, an onerous contract. So basically they had one for each of those. And that is why it's important for you to make sure that you read your standard so that you know of the various aspects within the standard. So what I just did, I opened up my book. I already knew the stuff, because once I realized it's all of those stuff, I knew the basic criteria. But because I wanted a discussion, I always open up my handbook for a discussion, and I just look at the terminology. So I make sure I'm following the right thinking process, order, and so forth. I'm not learning it right there. I know it. It's just that I use it as a guide. So make sure you do make some time to read your standards. Okay. So same for leases. What I recommend for leases is long. So you may not be able to read everything in one go. You will read it over the next few weeks, right? But as a starting point, look at the contents page. That is how I set notes, by the way. I look at the contents page, and I'll see all the issues, and then I draw myself in my head. I draw a mind map in my mind, so how I can explain this in an easy way to you guys. And then once I had that mind map and a big picture in my head, and I run it through my mind to see if I'm just saying stuff that I can understand, or if I'm saying it in a manner that it is possible for someone else to understand, then I break down into the detail. Don't go the other way around. Don't go into the detail. Start off with the big picture and then break down at the various details. Okay, so very important. So for leases, try to do that. I don't know what the new handbooks that you have, but when I had the accounting handbooks, they always have like an introduction. So I think they took away the introduction. So generally they'll have an introduction. So if you just read the introduction, it gives you, it's like probably like, depending on the standard. So because leases is quite a big standard, the introduction may be like 7 or 10 pages. You just read over it and it gives you the big issues relating to the standard. It helps you immensely so that when you do start reading the standard, you at least have some kind of background. So just make sure of that. So remember over here, how can the opening balance go from the opening balance to the closing balance? An addition, a new lease. Depreciation, your subsequent measurement, you're depreciating the asset throughout for that period. A remeasurement or reassessment, whatever it is, remember this reassessment or remeasurement impacts the lease liability. So it'll either increase the lease liability or decrease the lease liability. In this case, it decreased the lease liability. Then the standard says the other side goes to the right of use asset, and that is why we also have it in over here. Then remember, included in the right of use asset is the decommissioning liability. That's one of the 4 components. So because if there is a change in the decommission liability, either there's a change in the amount or there's a change in the, so there's either a change in, because remember, we estimate 250, but as time goes on, that estimate may change. Or, or what happens, we use a discount rate, but as time goes on, the discount rate can change. So either the discount rate change, or if the amount change, we have to do a remeasurement, another remeasurement of the decommissioning liability. That change in the remeasurement will impact the lease liability, the decommissioning liability, as well as the right of use asset. Remember, the journal entry for this is debit asset, credit decommissioning liability. So because the decommissioning liability is changing, the right of use asset, the corresponding asset will also change. The corresponding asset in this case is the right of use asset. So what would happen? The decommissioning liability. You can call it whatever you want. I'm just going to call it decommission liability. You can call it provision for restoration, whatever. Provision for dismantle. Same thing, doesn't matter. Okay, so decommission provision. Let me not call it a liability. I'm going to call it a provision, because technically it's not a liability. There's a difference between a liability and a provision. So I'm going to call it a provision. That's more technically correct. Yeah, I missed out. That's fine. So now we can go about plugging in the numbers. Remember, this opening balance over here, is equal to that closing balance. Okay, so it must equal to each other. So I'm just going to do that. So remember our period in 2018, 1 March 2017 to 28 February 2018. 1 March 2017 to 28 February 2018. Then 1 March 2018 to 28 February 2019. Now, this lease with Herman only happened on 1 October. This lease of Herman the commencement date was 1 October 2017. 1 October 2017 is after 1 March 2017. Therefore, the opening balance for 1 March 2017 for the 2018 financial year will be 0. There was nothing. Okay, so that means the addition will be the initial measurement on 1 October 2017. Initial measurement on 1 October 2017, that would be the addition. There was no new addition in 2019, so we know that's going to be 0. Once we have the asset, we can depreciate it, and we will be able to depreciate it over here and there, and then there will be a remeasurement. So remember, there was no remeasurement in 2018, but there was a remeasurement in the 2019 financial year. On 1 March 2019, or on 2nd March 2019, Herway got the news that about the court case. So as a result, it said that the lease liability will be reduced by 345. The lease liability will be reduced by 345. So that journal entry was debit lease liability 345. For every debit, there must be a credit. What is the credit? The right of use asset. So that would be minus 345, whatever the answer, whatever it was. $345, $248. We want numbers excluding that. Okay, so 248, 345, 248. So just take note of that. The decommissioning liability, there was no impact in the There's no impact in the current year, but there was a change. I mean, there was no impact in 2018, but there was a change in 2019. That change we're going to have to calculate. So there are two. So we have to calculate that number. Then we have to calculate depreciation, and then we have to calculate the change in decommission. Okay, then we have to calculate the change in decommission. Okay, so let's have a look at the workings. Okay, so for working one, we're going to work out the, we have to work out the lease liability, and we have to work out the right of use asset. Now remember, I just quickly want to go fetch that notes I sent you guys. So I'm not going to stretch my brain right now. I'm just quickly opening the notes I sent you. So let's see, what did I say? Okay. Okay. Okay, so remember the right of use asset is made up of 4 components. So we're going to calculate the right of use asset is made up of the lease liability. It is made up of, what was the other thing now? Lease liability. It was made up of the lease payments made at or before commencement date. So the lease payment made at or before the commencement date is basically called prepayments. Okay, so prepayments. And the other one is direct costs, initial direct costs. Initial direct costs, but not any initial direct costs. It must be incurred by the lessee. Okay, remember another scenario will maybe give you 2 types of initial direct costs, one incurred by the lessee and one incurred by the lessor. In this case, we're only interested in the one incurred by the lessee. Okay, and then finally, it will be the decommissioning liability. Okay, what did I call it over here? Let me just see. Yeah, so let's say dismantling and removing, whatever. So just basically the provision for dismantling, provision for restoration, whatever you want to call it. I'm going to call it the decommissioning liability. Okay, decommission liability. I mean provision. Okay, so that is what's going to make up our right of use asset. Okay, so our right of use asset. So this is initial measurement. When is initial measurement? 1 October 2017. Okay, so right of use asset, 1 October 2017. So this amount is the amount at initial recognition. So sum is that. Okay, so they gave us the decommission. Let's just have a look. What was this decommission? It was 101,984. That is the present value. Remember the 250. So on 1 October 2017, the 250 is that is in 10 years time. The 101,984 is the present value today. You should be able to get the 101 by discounting that 250 over a 10-year period, you should get to 101,984. Okay, so you can recalculate it if you want to. I'm not going to recalculate it, but it's given. So it is 101,984. So remember, the journal entry for that would be debit right of use asset 101,984, credit decommissioning liability. Now remember, I told you that in subsequent measurement, there are two sets of journal entries, one relating to the lease liability, one relating to the right of use asset, and one relating to the lease liability. So the right of use asset is depreciated, that's correct. But what you must not forget, that you have a decommissioning provision. So every year, you're going to have to recognize an interest expense against the decommission provision. So don't forget that. A lot of people will forget it, but don't you forget it. So whenever you have a decommission provision, don't forget. The one part is still to do the depreciation against the actual asset, but you must also recognize the expense relating to the decommission provision. Please be aware of that. Okay, there was no initial direct cost incurred by the lessor. There was a prepayment of 57,500. So remember the 57,500, this is given. Okay, so now we might just calculate the lease liability. Okay, so just be aware of that. So there we had the decommission provision. We have initial direct cost. There was nothing, the prepayment. And now we must do the lease liability. So working two, we're going to work out the lease liability. Remember, the lease liability has 5 components. I was going to go back to the notes. I can't remember the 5 components. Okay, I mean, I can remember, just I want to stretch my brain right now. So it's fixed payment and then variable payment. So fixed payment. So remember, it's fixed lease payment, right? Not any fixed payment, a fixed lease payment. And then variable payments. Now remember, there's not any variable payments. Okay, so remember, like I said, many scenarios will have a variable payment that is linked to the revenue of the company. We're not talking about that. That is a separate, you must account for that separately. Okay, so just be aware of that. So this is variable payments linked to an index. So I always just put everything in, like all 5 components, all 4 components. In an exam, you don't have to do that if it's not there. I do it so you can so you can see how you go about doing it, as well as that's how I usually train myself. I always include everything, and so when an exam comes, I know all the stuff I must be aware of, and I'll only put the relevant stuff in an exam, so not to waste time. Okay. Okay. Sorry, what was that? So it was a fixed payment, variable payment. The next item was so amounts expected to be payable by the lessee under a guaranteed residual value. Okay. So this is the guaranteed residual value. Okay, so this is payable by lessee. Okay, so remember, it doesn't have to be by the lessee. Okay, so just be aware, it's not any guaranteed residual value, it's only a guaranteed residual value guaranteed by the lessee. Then it's going to be any termination. What was that? Then it's going to be purchase option, and then any penalties for early termination. Okay, so purchase option, amount, penalty for early termination. Okay, so there we go. Okay, so variable lease payments, there is nothing. Guaranteed residual value, there will be nothing. The purchase option, there's no purchase option, and there was nothing for the termination of the lease. Okay. And then the fixed monthly payments, so fixed monthly payments was 9,775. Okay, so 9,775. But remember, in order to calculate this number, we need to use the financial calculator. So what do we want? We want the present value of the lease liability. That's what we want. We want the present value of the lease liability. So therefore, we're going to need a future value, and we will need PMT, we're going to need N, and we're going to need I. Okay, so we're going to need PMT, we're going to need N, and we're going to need I. So we want the present value. That is what we want. So we want the present value, which is that. So we want the present value. So we'll need a future value. So remember, the future value would either be the guaranteed residual value. It could be as well as the purchase option amount. It could be the penalty for early termination. Remember, what is the future value? The future value is the lump sum payment at the end of the lease term. So the future value is the lump sum payment at the end of the lease term. And generally, the guaranteed residual value is paid at the end of the lease term. The purchase option is paid at the end of the lease term. Okay, so just take note of that. Same, the penalty for early termination will have. So remember, when there's a penalty for early termination, your lease term will be limited to that when you expect to terminate, not the full lease term. So once again, the penalty will also then be a future value, but that will be the lump sum payment at the end of the lease term. So just take note of that, okay? So therefore, it is all zero, so future value is zero. PMT will be the fixed monthly payment. If you have a variable payment, then you can't use the 5 buttons on the financial calculator. You're most likely going to have to use the cash flow button on the calculator. So on Excel, how do we do the cash flow calculation? Like we do capital budgeting. We do the cash, the number of years. So if you have a variable payment, okay, because remember, a variable payment is not a fixed regular payment. PMT refers to the fixed regular payment. The fixed regular payment can only be the fixed monthly payment. So that's very important to take note. Okay, and then we need N. N is a period of 10 years. But remember, I just want to check that quickly. I think if I read that correctly. So N is a period of 10 years. So here they're telling us in 10 years' time, they say it's compounded monthly. Okay. I'm not sure here. Okay, so I'm assuming it's compounded monthly. So remember, the monthly payment is 997. So N is going to be the number of years times the number of compounding periods, or the number of payments periods. So every month, so it's 10 years multiplied by the number of compounding periods per year. Because they're happening monthly, so the compounding period per year is the number of compounding periods per year is 12. I is going to equal 9%, but remember, it's 9% per annum compounded monthly. So therefore, to get it to a monthly amount, we must divide by 12. So just take note. Here you can see PMT is a monthly amount. N refers to the number of monthly periods. These are 120 monthly periods because we have a monthly payment. And I is a monthly rate. So just make sure PMT, N, and I always talk to each other. Okay. So PMT is a monthly amount. N refers to the number of monthly payments or periods, and I refers to the monthly rate. All of them, all in the same. They are what do you say? They're apples with apples with apples. Okay, very important. Now I can calculate present value. So present value equals. They probably want, I think, rate first. Then they would want N. Then they would want PMT. Then they would want future value, and then whether it's the beginning of the period or end of the period. Now you must be very careful. Generally with leases, payments happen at the beginning. So you want to put your financial creditor at the beginning. I think in this scenario, they said at the end of the period. Okay, yeah, they're not telling us whether it's at the end or the beginning, so we can assume it is at the end. Okay, so just be aware of that. You must just pay careful attention, especially in a lease, because generally in a lease, you pay at the beginning of the period. Just think if you lease a flat or something, the tenant don't take lease payment at the end of the month, they take it at the beginning of the month for that month. But because they're silent over here, we're assuming it's the end. So I think that would be the lease liability. So the present value is 771,65655. So now that is what I'll go and plug in over here. The addition is equal to 77. No, that's not what I'm doing. Sorry, let me just take that out. The lease liability is over here, equal to negative 771,655. So there we go. So on 1 October, that should have been the addition. Okay, so the addition on 1 October would be equal to 931, whatever it is, 931,139. Now we can work out depreciation. So depreciation over the useful life, over the lease term of 10 years on a straight line basis. Okay, so depreciation. So depreciation 1 October 17 to 28 Feb 18. That's how many months? October, November, December, January, February. October, November, December, January, February. 5 months. Okay, so that is 5 months. So all I can do is the following. It is basically going to be cost price divided by useful life multiplied by time. Okay, so basically it is cost price divided by useful life of 10 years multiplied by 5 divided by 12. Okay, so if I do this, so depreciation is negative, so negative 930, whatever that is, divided by 10 multiplied by 5 divided by 12. Okay, so that will be my depreciation for the 5 months. Okay, so that means my carrying amount at, so my carrying amount at whatever this date is. So the right of use asset carrying amount at 31 December. So my right of use asset, so carrying amount 28 Feb 2018 would be the sum. Okay, so if I do this, it is equal to depreciation over there. Okay, so now what happens? Now what happens on 1 March 2019, the beginning of the financial year, is a remeasurement. So at the beginning of the financial year, there is a remeasurement, or whatever it's called. I just want to get the right terminology quickly. Just quickly, I have the standard open here. I just want to check quickly. What's it called? Reassessment. Okay, so it's a reassessment, not remeasurement. So reassessment, let's call it that. Reassessment. Reassessment. Okay, so the reassessment is 345. So I'm going to put in here copy it over. So the reassessment, when did it happen? Basically 2nd March, which is 1st March. So 2nd March 2019, which is the beginning of the financial year. What happened? There was a reassessment, a decrease to the liability. There was a decrease to the liability. There was a decrease to the liability. There was a decrease to the lease liability on 2nd March by 345. So we say debit lease liability 345. For every debit, there must be a credit. The standard says when there's a reassessment, you must take when there's a reassessment that changes the liability, that change, the other side of the transaction goes against the right of use asset. Okay, so the other side goes to the right of use asset, which is minus 345. What was it now? 248. Okay, so that's important. But now remember, that wasn't the only change. That was not the only change. This was not the only change. There was also the change to the decommissioning liability. Okay, so there's also a change to the decommission liability. When there's a change to the decommissioning liability as a result of one of two things, either both of them or one of them, a change in the discount rate and or a change in the ultimate payment, then that change will impact the decommissioning liability as well as the asset that the decommissioning liability relates to. So in this case, the asset that the decommissioning liability relates to is the right of use asset. So if the decommissioning liability increases, we're saying credit liability. For every credit, there must be a debit. What would be the debit? An increase to the right of use asset. Okay, so just take note of that. So it'd be an increase to the right of use asset. If the decommissioning liability decreases, we're saying debit decommissioning liability, and we're going to say credit right of use asset. Okay, so just take note of that. So there's going to be a change in decommission liability or provision, decommission provision. So we have to work out the impact on the decommission liability. So this is how we're going to deal with it. Okay, so working 3. So for working 3, remember the decommission liability, the decommission provision at the beginning of the year, the decommission provision at the beginning of the year, which was, so remember the beginning of the year in this case is, so let's first start with 1 October when it first came in, 1 October 2017. When it first came in, it was 101, 3, what was it? 384, I think. 101, 984. Okay, so 101, 984. Now remember I said that, so for the right of use asset, you're having a depreciation in subsequent measurement. But because the right of use asset also includes a decommissioning liability, there's also a subsequent measurement relating to the decommission liability provision. Remember, the decommission provision does not fall within the scope of an asset. It falls within the standard IAS 37. So the chance of it coming in is high because IAS 37 is one of the topics of this section of test 4. Okay, so just be aware of that. So the subsequent measurement relating to a decommission liability is basically this. You will have, it will be basically the subsequent measurement relating to a decommission liability is basically this: debit, credit. You're going to say interest expense, P&L, and it's going to be credit decommission provision. Okay, so decommission, which is a provision, is a liability. A provision is a form of a type of a liability. So that is going to be SFP. How you work it out? In the same way you work out interest. How do we work out interest? Present value multiplied by the interest rate. Present value multiplied by the interest rate. Okay, so what we're going to do over here, we're going to add the interest. We're going to add the interest, which will give us the decommission liability, which will give us the decommission liability, which will give us the decommission liability at 28 February 2018. So this will give us the decommission liability 28 February 2018. Okay, so we didn't. There was no need to do this long approach. I'm only doing this long approach with you so that you can see the full picture. Okay, all we needed to do is work out the present value at 28 February 2018. So basically the present value at 28 February 2018. So I'm going to say present value. It doesn't matter what I want to do. Okay, let's just say future value. So we're going to work out the future value. Present value we have. So we need PMT, we're going to need N, and we're going to need I. Okay, so remember, we want the future value at 28 February 2018. So I am at 1 October 2017. And I want to get to the present value at 28 February 2018. So I am at 1 October 2017, and I want to get the value at 28 February 2018. So if I'm going forward, that is future value. If I'm going backwards, that is present value. So because I have 1 October's number, and I want to go to 28 February 2018, I'm moving forward. So that is why I want to calculate the future value. So the present value I have, which is 101, 184. The PMT, with a decommissioning liability, there's no fixed regular payment. Okay, there's no fixed regular payment. All that happens in the real world, it's required by law, right? So, well, in like for mining companies and so forth, it's required by law. So what would happen? A mining company, they obviously mine, right? And they destroy the ground. At the end of the mine, what do they have to do? They have to restore the ground to its original condition, or to a certain condition that is environmentally friendly. So what do? they would estimate how much it will cost. So let's say, like, let's use this example. They have the thing now, 1 October 2017. In 10 years' time, they're going to incur, they need 250,000 Rand in order to fix up. So what do? They work out the present value and they put this 101 into a bank account. So they put this 101 into a bank account and it will earn interest so that in 10 years' time, they have the 250. Now, in the real world, they may not put the exact present value. I think, like, from a mining company's perspective, there's a requirement that there's a minimum amount they need to put in. But let's just, for argument's sake, say the minimum amount is the present value. So you'll put the present value into a bank account, and then over the 10 years, the bank account will earn interest. So at the end of 10 years, you will have the amount that you anticipate. Okay, so that is basically what happened. So there's no fixed regular payment that goes in. So that is just basically zero. Now we want N. Now remember, we're saying we are at 1 October 2017 and we're moving forward to 28 February 2018. So 1 October to 28 February 2018 is 5. So the number of payments, it is 5 payments. I is equal to 9% divided by 12. We want the monthly percentage. Okay, so just take note of that. Yeah, this is mathematics, right? This is financial maths that you have learned in first year and in high school, did from financial maths in high school. And in first year, you did some maths, right? So, and in some way in MAC, you had to cover time value of money. Okay, so this is time value of money. So the future value is as follows. I just want to see quickly what do I need. So the future value, rate in PMT present value. Okay, so they want rate in PMT and PV, and then remember payments happen at the end of the period, so I'll make it 0. So the present value is 105. So at 1 October, at 28 February 2018, the present value is equal to 105,886. So just for you to know, the interest will just be the difference between the two. Okay, so I'll just show you the interest is 105 minus 101. So the journal entry over here would have been debit interest costs 3,882 and credit provision with 3,882. So your initial amount of the provision on 1 October was 101. Now at 28 February, you process the journal entry like that. So your liability, your provision for the decommissioning at 28 February 2018 is 105,866. Okay, so that's what happened. Now, what took place? On 2nd March, effectively on 1 March 2017, so I mean 2019, sorry, what am I doing over here? 1 October 2017. Okay, so now we need to work out interest again. I shouldn't have done this. I actually want to change this. I'm gonna jump straight ahead to 28 February 2019. Okay, so I'm gonna jump straight ahead to 28 February 2019. So I'm gonna change this. It is 5 plus 12 equal to 5 plus 12. So it's 17. Okay, so over 2017, and obviously you must record each period in their own period, but over the 17 months from 1 October 2017 to 28 February 2019, this would have been the interest being recognized. Okay, 5 months in what we call it, 12 months in 2019. Okay, so now, wait, am I doing something right here? Let me just read again quickly. I think I made a mistake. On 2nd March 2019, what was our financial year? Oh, okay. Okay, so this is an important aspect I need to bring to your attention. Okay, I'll tell you now. Okay, I'm just gonna go through this. Okay, so 28 February 2019, so that is right. So now what happens is the decommission of the provision 28 February 2019. That is basically what is happening. But now we know there's some court case that took place and we have to make a change. As a result of that, the useful life changes now to 2 years. So because the useful life changes to 2 years, we need to do a recalculation. Okay, so now we need to do a recalculation. So what we have to do is the following. Okay, so this year, so adjusted decommission provision 28 Feb 2019 is as follows. So working 5, once again, so we know in 2 years' time, we're going to pay 200,000 Rand. We want the value today. So we're going from 2 years to now, we're going backwards. So we need a present value. We're going to need the future value. We're going to need PMT. We're going to need N. We're going to need I. What do we know? We want PV. The future value in 2 years' time is 200,000. PMT, there's no regular fixed payment. N is 24. 2 years times 12 months. 2 years times 12 payments, 12 compounding periods per month. And then I is 9% compounded monthly. So we divide by 12. Okay, so just take note of that. So now we can work out the PV equal present value. We need discount rate. We need N. We need PMT. We need future value. And payments happen at the end, so I'll make it 0. So we have 167. So the adjusted decommission provision is equal to 167. Okay, and this is going to be working 5. So the adjustment that needs to be processed is the difference between the two. So the adjustment is the difference between the two. So as you can see, at 28 February on the original information, the liability is 115. With the new information, the liability is 167. What's happening to the liability? The liability is increasing. So we're going to say credit decommission provision with whatever the amount is. For every credit, there must be a debit. The debit goes against the right of use asset. Okay, so adjustment is going to be the difference, which is 167 minus 115, which is at 51,000. That 51,000 is an adjustment that needs to be made against the right of use asset. Okay, so we go to the right of use asset over here. So working 3. So remember, the provision increase. So we said credit provision. So for every credit, there must be a debit. The debit goes against the right of use asset. A debit to an asset is an increase to the asset. Okay, so that is basically, so the carrying amount. So remember, that is a, so now we have we needed to make this adjustment because we're going to have to depreciate the asset. Okay, so basically what we can do, whatever the asset is over here, whatever this amount is over here, adjusted CA 28 Feb 2019 before depreciation. So that is the amount. So at 28 February 2018, the adjusted carrying amount of the asset is 598 before depreciation. So now we still need to do depreciation. Remember, depreciation must be spread over the useful life. The useful life has changed. There's a change in useful life. It was 10 years. It is now 2 years. So therefore, the depreciation, when there's a change in useful life, we say carrying amount divided by the remaining useful life. So depreciation 1 March 2018 to 28 February 2019 is 1 year, right? But remember, because it's a change in an estimate, there's a change in useful life, we have to say carrying amount divided by remaining useful life. So the remaining useful life is 2 years. The carrying amount is that carrying amount before depreciation. So it is basically 598 divided by 2. So now the carrying amount after depreciation would be the sum. Okay, so depreciation, we're going to make negative. I'm just going to copy this over quickly. And this now is after depreciation. So if we go to this thing over here, opening balance equal closing balance. So there's closing balance, opening balance equals closing balance. We need to bring in depreciation. So depreciation for 2019 is at 299. We brought in the reassessment, right? And there was a change to the decommissioning provision. So adjustment to the decommission provision, and we're going to bring in that over there. Okay, so there we go. So if we have a look, that would be our carrying amount. So our carrying amount so here we go. Opening balance in 2018 is 0 because we only got it in the current year of 2018. Okay, so we only got it during the 2018 financial year. So the addition is the initial measurement of the right of use asset. The right of use asset includes 4 things, which is the lease liability, the prepayment, initial direct costs, and the decommissioning provision. Then there will be a depreciation during the current year. Any reassessment, there was no reassessment in the 2018 financial year, and there was no adjustment to the decommissioning provision. We have our closing balance. Our closing balance of 2018 becomes the opening balance of 2019. In 2019, there was no addition, there was no new lease. So therefore that is 0. Depreciation is the carrying amount divided by the remaining useful life. And we calculated to be 299. There was a reassessment. Remember what triggers a reassessment? If there's a change in the lease term. What happened? The lease term was a full 10 years, but it now reduced. Only 1 year, only 17 months passed. So that means we expected it to be 10 years minus 17 months, but it was no longer 10 years minus 17 months. It was now 2 years. So that triggers a reassessment. So they're telling you the reassessment adjustment was 345. It reduced the lease liability. Debit lease liability credit right of use asset. So the right of use asset is decreased by 345. Then we also had an adjustment to the decommission provision. We estimated the decommission provision to be 250. But when the information came that we're gonna have to incur the cost in 2 years' time, the new estimate was no longer 250, it was 200. So because the cash flow estimate changed and or the discount rate change, that change impacts the decommission provision as well as the related asset. So the decommission provision increased. So we said credit decommission as a result of this change. For every credit, there must be a debit. The debit must go against the related asset. The related asset is the right of use asset. So you're debiting the asset increases. So that is basically what we're doing over here. So remember, it's very important to understand with the right of use asset, when it comes to subsequent measurement, there are two sets of journal entries. The journal entries relating to the right of use asset and the journal entries relating to the lease liability. With the right of use asset, we usually have the depreciation. But because the right of use asset also have a decommissioning liability, don't forget, every year you must process this subsequent measurement journal relating to the decommissioning liability as well. Okay. This 551 doesn't happen every year. That 51,000 only happens when there's a change in the information relating to the decommissioning provision, either a change in discount rate or a change in the cash, the estimated cash flow. So this journal entry would have looked like this: decommission provision, and then right of use asset, SFP, credit decommission, this is increasing. For every credit, there must be a debit. So that is that journal entry. So just take note. There's just one thing I want to bring to your attention. We needed to deal with this as at 28 February 2019. Okay. The change to the lease liability and to this reassessment and that adjustment happened on 1 March and on 2nd March 2019, after 28 February 2019. So why did we do the change as at 28 February 2019? Remember, we said there was a court case and we received information on 2nd March and on 1st March. So 1st March and 2nd March falls in the period from financial year end up until the date that the directors approve the financial statements. The directors approve the financial statements 30th April. So we received information about the court case during that period. The question we needed to ask ourselves, is it an adjusting or a non-adjusting event? If it is an adjusting event, we change the numbers. If it is a non-adjusting event, we do not change the numbers. Then this would have only happened in the 2020 financial year. But what made it an adjusting event? It is because it relates to information we knew as at 28 February 2019. So as at 28 February 2019, there was a court case. We knew about everything and we knew there was a possibility. Because the change, even though the change happens after the reporting period, but it relates to something that existed at the reporting date, it becomes an adjusting event. But I'll go into more detail when we come there. I just wanted to bring it quickly to your attention regarding that. Okay, so that is basically lessees. Okay, this is a different way of asking the question, but it really tests your understanding. So that's all I wanted to cover for tonight. Is there any questions on your guys' side?
No questions.
No questions.
No questions.
Anything confusing on your guys' side? Bernice, Felice, Faid, anything confusing your guys' side?
No, not really.
Nothing confusing.
Everything clear, like crystal clear, like crystal clear. Yes or no?
Nothing is clear in CTI, but
Then that means exactly my point. So that means, how can you say nothing is confusing? So
but it doesn't mean it's also clear. It's in between.
in between, so in the gray area. Okay.
The 50% zone.
Rodney, Ryan, Fakir.
All good with me, thanks.
Fakir,
Oh yeah, nothing confusing so far. Just have to work with the question again.
Ryan.
I'm all good, nothing confusing at the moment.
But can you do this question now?
Well, I'm going to try it again now, yes, but I can't promise anything that I'll do it
Okay.
100%.
Okay, but that's so this is go and practice. Remember, try to make sure when you do this lease question, any lease question, actually any financial reporting question, but particularly for leases, because there's too many different scenarios I can ask. Just make sure you can calculate the right of use asset and the lease liability as at the end of the reporting period. Okay, number one. Then you must know all the stuff that got you to that closing balance. So for example, like we saw, it was a depreciation, it was a remeasurement or reassessment, as well as a decommissioning change. So just make sure you can get to the end of the balance and all its movements. Because if you can get to the end of the balance and all its movements, you can do the disclosure and you can do the calculation. Then you just need to ask yourself, okay, for each movement and for each balance, how does it impact the income statement? How does it impact the balance sheet? As you can see over here, I'm going to just quickly show you something, then we can go. As you can see over here, this journal entry only impacts the balance sheet. This journal entry impacts the balance sheet and the income statement. So if they ask you, dear student, please prepare the note, the profit before tax note, then you must know that interest needed to come in. Okay, so just be aware of that. So what you want to do, like I say, you want to be able to get to that closing balance. So this closing balance is what's going to be on the statement of financial position. This closing balance is going to be on the statement of financial position. So that's the impact that it has on the balance sheet. The impact it has on the, how do you get there, is through all of these changes. Okay, so all of these changes. So those 1, 2, 3, 4 items changed the balances. But the only ones that impact, so remember, only a transaction has a possibility of impacting the income statement. So the only ones that have an impact on the income statement is that line item over there. This reassessment was credit right of use asset, debit lease liability. So it's balance sheet. This transaction was debit right of use asset, credit lease liability. So it's balance sheet. This over here was debit depreciation, credit accumulated depreciation. Depreciation is P&L. So this would have a P&L impact. This over here was the journal entry over there would have been as follows. So this journal entry of 931 would have been as follows. Right of use asset, lease liability, prepayment, decommission, provision. This is the initial measurement journal, the initial recognition journal. Debit, credit, SFP. So the journal entry would have been that. So right of use asset, addition at initial recognition, we have the right of use asset. Right of use asset increases by those 4 components. So an asset increase on the debit side. It increased, we have a liability, so we have a lease liability at initial measurement, at initial recognition of 771. We have a decommissioned liability of 101,984. Okay, so that is what we dealt with over here. 101,984, recognized interest for the 17 months. And so at 28 February, we had that, but there was a change, there was adjustment, and then we recognized that. Okay, so just be aware. Then remember the prepayment on 1 October 2017, Herway said, Credit Bank, they made a payment of 57,000 Rand to 57,000 Rand to away for this airfield. So they said Credit Bank, for every credit there must be a debit. What did this debit, what did this credit, what did this payment relate to? Just basically a deposit. A deposit is a prepayment. Okay, so on 1 October that happened. Now, when the lease actually commences, so they no longer have a deposit, the deposit is credited and taken against the right of use asset. So that is why we reduce the deposit. So at 1 October 2017, when they made the deposit, they said Credit Bank, debit, deposit, debit prepayment. Now when the lease commences, the deposit is no longer a deposit. It now forms part of the right of use asset. So because it's no longer a deposit, we have to get rid of the deposit. The deposit is an asset. To get rid of the asset, you credit an asset. So you say credit asset, credit prepayment. For every credit, there must be a debit. The debit is sitting in the right of use asset. Okay, so this is a typical question. If we had to have this year initial direct costs, the initial direct costs will generally be paid cash to the lawyers, or we pay the lawyers next year. So we'd have just say Credit Bank if we pay the lawyers cash, or credit trade payables if we must still pay the lawyers. Okay, so just be aware of that. For initial direct costs, it would have just been bank or trade payable, SFP, and whatever the amount is, in this case, it's 0. Okay, so that is basically the right of use asset journal entry, or the lease journal entry at initial recognition. Then at subsequent measurement, you will have depreciation, accumulated depreciation. This is for the right of use asset, P&L, SFP. For the lease liability, when you make the payment, now remember in this scenario, we also have a decommissioning below. So in this scenario, we also have the decommissioning below, which is debit interest expense, credit decommission liability, decommission provision. But we won't always have it. Because we have a decommission provision, we will have a journal entry over here as well, interest expense, P&L, and then decommission provision, SFP. So that is the journal entries relating to the right of use asset and the decommissioning liability. Then for the lease liability, we're going to make a payment. So we're going to say Credit Bank, and then it's going to go to lease liability. Lease liability is the balancing figure, which could either be a debit or a credit, and then interest expense. So here we have P&L, here we would have SFP, here you have SFP. So what would have under credit? The lease payment. The debit, and then the debit to interest expense, the lease liability is the balancing figure. It could either be a debit or a credit. Decommissioning, it's going to be a credit. The interest expense will be that. Accumulated depreciation is that, and depreciation is that. So that is your subsequent, this is your subsequent measurement journal entries. Remember, you only have this one if you have a decommissioning liability. This is your initial recognition journal entry. Okay, so I'll leave you at that. So please practice. This one may change if it doesn't coincide. Okay, so if the lease term does not coincide with the financial year end, then you won't have this journal entry. It will be some other type of journal entry, but that's for you to figure out. Okay, I'm going to stop here. If there's no other questions, you guys are good to go. So I'll just wait for 1 minute. If there's no questions, I'll end the lesson.